Hello, everyone. Mike here. This is our third quarter update. So today I'm going to talk a little bit about what happened over the past quarter, where we are now, what we see going forward into the future. So I'm going to share my screen up here, and I'm going to go ahead and launch this, and let's see how this goes. All right. So here we are, state of the market, third quarter. Third quarter, as you know, a bit of a roller coaster, right? For markets, we hit yearly lows towards the middle to end of June, and then it kind of bounced back, and then it dropped down to hit new lows, I think, towards the end of September. So let's look at some of the data. Let's see what's going on, and let's see what we can learn. By the way, got to make sure we get our handy disclosure up there, right? Okay, so this is a stock market from January 1 through September 30th. At this stage, markets are down roughly 25% for the year. They're getting, hit pretty good. NASDAQ, that's down 30. The Dow is down 22-ish, 21. And the Russell, this is really a good picture of the market right here, because this is the 3,000 largest companies. They're down also about 25, 26%. And, of course, international is no safe haven. Just like in the US, internationally, that's actually down about 30%, just like the NASDAQ. So what's causing all of this? Right? Why are the markets getting crushed? Well, first off, we have gross domestic product, which is the size of the economy has been dropping. And the definition of a recession is when it goes down 2 quarters in a row. So the first quarter, it was down 1.6%, the second quarter down 0.6%. So that would be considered a very mild recession. And there's a forecast that's supposed to be up in the third quarter. I kind of doubt that's going to happen, but you never know. So the forecast should be up a little bit third quarter. We won't know that for a few weeks here, but let's just say I'm not very optimistic that that's going to be a green arrow here. Treasury rates. Now, what's going on? We know that inflation is rising. That means that the Fed has been increasing interest rates. Well, what do we have? We have a 2-year Treasury is its highest level in 15 years. It's over 4%. So we have currently, and we've had for some time now, what's called an inverted yield curve. And what that means is that short-term rates, like the 2-year Treasury here, are actually higher than longer-term rates, like a 10-year Treasury, which is upside down. It's backwards. Now, why is this important? Because this is a screaming red flag that a strong recession is coming. Now, just because we have an inverted yield curve does not mean that a recession will follow. So we've had inverted yield curves in the past like this, and there's been no recession that followed. However, every single recession that we've had has had this red flag happen beforehand. So the last time, by the way, this is kind of important. The last time the 2-year Treasury was this high, 4%, was back in the end of 2007, right before the 2008 crash. So that's not a really good signal to be looking at right now. Inflation. Oh my goodness. Inflation has gone up, and so far the Fed, they want to increase interest rates. That's how they battle inflation. They've not been very successful yet. Maybe they've slowed the growth of it, but it's still up there. Latest numbers are that inflation's still around 8.3%. And the problem with that is it's starting to dip into people's savings. Savings rates measure, how much disposable income people have after they've been paid. In July, savings rates was only 3.5%. And a year earlier, it was 10.5%. So a third of what it was just 1 year ago. And inflation is a big reason for that. People have to spend more money for things, which means they have less money left over to save. We also have consumer sentiment. Consumers are not happy about high prices. University of Michigan measures that. September of 2021, we were at 72.8. A year later, 59.5. That's not a good change. So that's negative news causing problems. Now, one bright spot in all of this is the only bright spot we can find right now. Unemployment is still pretty low, 3.7%. So if you're looking for a job, it's still a pretty good time to get a job. Now, you may see some pressure on this as we go. As I look at my notes down here, several major employers like Goldman Sachs, Ford, Microsoft, they've announced plans for or have already started layoffs. So there could be some pressure on that going forward. But with that being said, there's still like 11.2 million job openings. We still see a lot of, hiring signs out there, if you will. Let's see, every industry, retail, restaurants, construction, manufacturing, every industry is still hiring for the most part. So that's pretty good to see. Now, by the way, speaking of construction in the housing market, this has been red hot over the last couple of years, as you know, but we've got signs of slowing. I've seen articles where Austin, here we are in Austin, Texas, #1 market for house prices going down. This year, house prices are down 10% from the beginning of the year. So already we're seeing that here in Austin. Mortgage applications are just vanishing. And why? Because the Fed's been raising interest rates. We've seen mortgage rates on a 30-year fixed mortgage cross 7%. We haven't seen that in years, and that obviously affects the ability for people to afford a home. So they haven't been this high since 2008. And not just mortgage rates, right? Just like a lot of people are almost feeling like, gosh, when I go to the gas pump, it's almost like I've got a mortgage payment, right there. We saw gas prices go over $5 a gallon nationally. They dropped back a bit. They're down to, I think, $3.80 right now. Still much higher than they were just a couple years ago. People are definitely feeling the pain at the pump. So here we have ongoing inflation, right? As we go into the fourth quarter, we're trying to say, what do we see going forward? Inflation, as you can see on the screen, still elevated. I mean, we were September 5.4, 6.2, 6.87, and all year it's been 7.5% to 9%, much higher than we've seen in many, many years. One of the reasons it ticked down a little bit in July, August, gas prices have dropped a little bit. But if you want to ask my wife, have prices dropped at the grocery store yet? She would tell you not that she's seen. As we go in the fourth quarter, some challenges. The Federal Reserve, they're still fighting inflation. So back in March, they started kicking off a rate increase of 0.25%. Then in May, it was 50 basis points. And then June, July, September, three quarters, they've increased interest rates by 3% this year, and it still hasn't stopped inflation. So you can expect that they're going to continue to increase interest rates. Now, I've heard a saying many years ago, and the saying was, don't fight the Fed. As long as the Fed keeps increasing interest rates, I believe you can expect challenges with the markets. The markets are not going to appreciate interest rates continuing to rise. And then we have the midterm elections coming up, right? Midterm elections are coming up. who knows what's going to happen there. As you can expect, I would expect markets to continue volatility as that kind of hashes its way out. So what should we be thinking about here? You know, it is back to basics. I will tell you that everybody's situation is different, of course. We are big believers that you want to have a secure retirement. You want to make sure that you're protecting your income. We know that when it comes to managing money for retirement, you have, you know, we like to separate accounts into growth accounts and income accounts. We want to protect your income, make sure that it's safe. And that gives your growth accounts time to kind of work their way through these types of market environments. On the portfolio side, you've probably seen that a lot of our portfolios have gone. We have very strong cash or cash equivalent positions. So we have a lot of money in very short-term treasuries because we believe there's a lot of market volatility on the horizon still. We're big believers that we haven't seen the bottom yet, that the market's going to continue to drop as we enter into the year. We believe that recession in a significant way is coming. As I mentioned on an earlier slide, and I'm just going to go ahead. I think, well, no, that's all right. I'll keep here. On an earlier slide, I mentioned how we've had a mild recession according to shrinking GDP. We think that there's going to be something much more significant. In fact, just this morning, I saw an article on CNBC. Jeff Bezos of Amazon, he's come out and said, hey, we are expecting significant recession in the near term. You're seeing that all over the place. So you're going to notice that our managed accounts, we're going to continue to be very, very defensive in those accounts and may continue to be more defensive yet. We'll see as time goes. But with that being said, again, if you want to reach out to us, you can email us, call us. We're always happy to talk. As I wrap this up, let me just see if I can stop sharing my screen and just kind of go back to just me. There we go. As we wrap up this third quarter update, my message is this. It's been a while since we've seen these kind of market environments. I've experienced this twice now in my career, once in the early 2000s, again in 2008. During these times, what I've learned is, it's okay to move a lot of money into cash on the sidelines as we wait out these markets, give them time to kind of work their way through. It's okay to, to just say, hey, I'm going to step out of the markets for a little bit with a chunk of my money. There's nothing wrong with that. And that's exactly what we're doing in our portfolios. We expect recession to be coming. If you're looking to sell your home, better hurry up and sell it to get that. I fully expect housing prices to continue to decline. Rising interest rates is horrible for home prices. And there's a lot of storm clouds on the horizon, but we're here for you, right? That's what our job is. We're here to help you structure your accounts so that you can protect yourself in times like this, so you can make your way through them and end up in a good position. Just feel free to always call us, email us. That's what we're here for. And look, I know that it looks like there'll be some tough times. At the same time, we've seen them. We have experience helping clients work their way through them. And I'm confident we'll be able to do so in this environment. So there you go, folks. That's our third quarter update. I know it's a little doomy and gloomy, but I'm still very optimistic that if you manage your money right, hey, we're there for you and you'll be in great shape. If you're watching this, maybe you've talked to us in the past, or it's been a little while and you're not a client, feel free to reach out to us and check in again. And maybe we can help you out, protect your assets and, help you make sure that you retire well. We believe retirement should be the best time of your life. Let's plan the right way so that you have the best chance of making that happen. All right. Enjoy the rest of your day.